2022 with our updated results for Q1 2023. We'll take questions at the end of today's presentation on the results, and can I ask people to use the chat function for questions or to raise hands. We also have people in the room with us here in CSO this morning, so we'll be able to take some questions from the floor also. Today's briefing covers the updated results for 2022 and Q1 23, giving us a more definitive picture for Q1 23 and for the earlier quarters and years. In these mid-year publications, we include additional or updated data from across all of the sources that feed into the national and international accounts. And my colleagues Chris and John will take you through the revisions this morning in the results. Also in today's results, the annual deglobalised or modified indicators, GNI star and current account star or CA star, are included. And we'd also like to take the opportunity today to present some of the more detailed analysis and developments available with the annual results. As always, this morning's slides will be available along with the publications on the CSO website, and a recording of today's presentations will be made available on the CSO YouTube channel. As I always say, contact details are available on our releases and on the press release, on the statistical releases, and on the press release. So please contact us at any stage with queries on results or today or any other queries that you may have. So I'll pass to Chris now to take us through the national accounts results. Many thanks, Chris.
Thanks, Jennifer. So I'll start with the annual results, the restated annual results for 2022, and I'll move on just briefly to discuss the updated quarter for Q1 23. So we have an enhanced set of data for 2021. That might seem like a while ago to a lot of people, but this is the first time we all really get to see company or micro data for the first time for 21 and its effects on into 22. So it's the first time post-COVID set of full data we have on microdata and the rebound post-COVID. So there's quite a lot of new information for us in there. You'll see revisions upwards to consumption in the data. I'll explain those a little bit later, and some changes to machinery and equipment. Two big changes in the annual series, and it affects a little bit how we interpret those series. We've also got the modified measures for you today, including GNI star at 6.7%. Just move on to the infographic. So across the top of the infographic we have the whole of economy measures, GDP, GNP, and the deglobalised measures, NNI and GNI star. So GNP now with a growth rate of GDP with a growth rate of 9.4%, taking out M&E profits, large M&E profits in 2022, brings us down to a GNP growth rate of 3.9%. And similarly, taking out all depreciation from that gives us net national income. We'll tell you a little bit more about those as well later, including GNI star and the transition to it. So GNI star, we had a large growth rate for that in 2021, and still considerable growth there in 2022 of 6.7%. Then MDD, modified domestic demand. This is looking just at the demand on the domestic side of the economy, leaving the foreign parts out. And that's up 9.5% for the year. If we look at our three methods of producing our results, GDP by incomes, GDP by producers, and GDP by expenditures, the top row of that green column there shows us all those domestic effects and how they lead us to that MDD result of 9.5%. Wages on the left, up 8%, domestic sectors up 6%, and personal spending up 9%. So that's that row of the infographic, all telling us what's going on with the domestic data and what leads up to the MDD measure. And the next row tells us about the foreign side to the economy, profits up strongly, foreign sectors up 16%, and exports up 14%, explaining kind of the GDP growth rate being driven by the foreign side of the economy. And then we've pulled out some kind of interesting facts on some of those measures in the bottom part of the infographic. What's going on with the wage bill in 22? Well, construction, the wage bill is up 28%. When you can contrast that with agriculture, where the wage bill or the cost of employing people in agriculture is down 8%. We look at our producer data and we see manufacturing sectors up 20%. And then an important one to keep an eye on post-COVID was the domestic sector, distribution, transport, hotels and restaurants up 17%. That's really what's driving a lot of the domestic data on the output side. And then looking at GDP by expenditures, lots of interesting data that we see for the first time today on that. So before we had very little detail, I guess, on consumption, and now there's about 40 categories of detail behind the consumption data in today's publication. So one of the things it tells us is that foreign travel's up 2.5 times, but that's, I guess, the bounce back post-COVID, but a big effect on the consumption data. We talked a little bit about this each quarter, but we hadn't got figures on it, I guess. Now we do for the year. We see it's 248 or 2.5 times what it was in 21. Another kind of interesting fact was that alcohol consumed at home is down 11%. So I guess the movement back into pubs and restaurants and the growth that we see there means that the consumption of alcohol at home is down. So that's our infographic for today. Looking at GDP and GNI star over time, the first thing to note is just GDP is down a little bit. I'll explain that in a moment, but that's mainly base effects. So we've added a lot to 21. So the GDP growth rate's down a little, so not too much to interpret there. I guess I'd look at the time series and say, look, this time last year we were sitting here talking about GDP and the modified measures being up quite strongly in 21 on the rebound from COVID. What we're seeing now for the year 22 with the deglobalised measures, GNI star up 6.7%, it's still quite strong growth there. So there's strong growth in all across the domestic parts of the economy and domestic effects as well from the M&Es, like we saw last year. That's giving us that GNI star result of 6.7%. So what revisions have we carried out, I guess, on the data? Why are we here with you again to give you a new set of data? Well, we have the latest data from revenue commissioners, the corporation tax, income tax, and the PAYE data. So that's micro data for firms and individuals. So that's the first time we can produce these firm-level detailed tables for you in things, for example, like profits. So you'll see those a little bit later on. We found more data, I guess, there in the industry sectors, the ICT sector in 21, and that gives us an increase on the output side and income side of the accounts in 21. For our structural business surveys from the CSO, we have our industry CIP and services ASI micro data sets to use for the first time for 21. And they told us a lot more about accommodation and food services, catering services. So these things added quite a bit to our consumption data. From the international accounts that John's going to explain, I guess, and the international trade in goods, cross-border goods data, we got new data there and revisions to that data. In particular, I guess, as changes to intellectual property in 22, we revision downwards, I guess, unusually for intellectual property in 22. And then the commodity flow estimates, everything that's produced versus what's consumed, and the balance what's exported or imported. That told us a little bit more about things like clothing and footwear, and that also added to consumption or PCE. There's two other changes we made through kind of a year's work looking at the data using meter data for electricity consumption. We've added a little bit more to PCE there, looking at meter data and a review of our kind of coverage of electricity. That's gone back about six years in the data revisions. And a final large change to explain today, I guess, is the machinery and equipment data. So again, micro data sets on that have told us that we were a little bit too high on machinery and equipment. So our indicator-based data and our surveys had a little higher weight than the full data sets on larger firms. So we scaled back that data on machinery and equipment. The growth in it's still the same, but the levels of it we've taken down a little bit. If we were to look at then GDP, why would we look at GDP in current prices? Well, lots of people use this as a denominator for assessment internationally of debt metrics, debt and deficit, and our spending measures. So that's, you'll see, it explains the kind of big picture on our revisions, I think, a bit. If you look at the year 2021, that's up from 426 to 434 billion, an 8 billion increase to 21, while we've had a 3 billion increase to the current price GDP in 22. So some of the revisions to 22 growth rates are base effects because of the larger growth and revisions for 21. So just keep that in mind, I guess, as we go through the data. Looking at GNI star, so this is the first view of GNI star we have for you for 2022. So those of you who haven't seen this before, the transition from it from GDP through to GNI star. First of all, we moved to GNP, taking off largely foreign profits or net factor income. We make a small change for EU taxes and subsidies to get us to GNI. And then the deglobalization set of adjustments, depreciation on IP, on leased aircraft, and redomiciled or corporate inversion income. So taking adjustments together for those altogether come to about 90, just above 90 billion, giving us a GNI star value in current prices of 273 billion. So we'll show you a couple of examples of what that's used for in a moment. But first, I just wanted to do the same walk for NNI. So it's largely the same process up to GNI, but it's a lot easier for us to generate net national income because once you get to GNI, we just take off all depreciation. Okay, so there's an extra 30 billion or so of an adjustment there. So it's a lower level indicator, NNI, and I have a chart of that in a moment, but it's a lot easier for us to produce this. So CSO is going to see if we can do a little bit more with NNI, perhaps on a quarterly basis. And maybe get a growth rate too on it in constant prices with appropriate deflators. So the use of this data, so if we look at the published government data, and there'll be latest release on that data next week, next Tuesday. But if we take today's GDP and divide the published government data by that, we can see the debt ratio falls for GDP on a GDP basis from 54 to 44%. And on a GNI star basis from 101% in 2021 down to 82%. So this is largely growth in the output of the GDP and the economy numbers, GNI star, giving you those changes in the debt metrics. Similarly for the deficit, if you use today's numbers, you can see the GDP based deficit go from minus 1.6 to plus 1.6 to 22. And if you look at it on a basis of GNI star, the deficit of minus 2.9 goes to a surplus of 2.9 in 2022. So that's the updated use, I guess, of those numbers. Just looking at these numbers over time, looking at the time series, I think it's worth pointing that out to people that the gap is increasing here. So when we started using these deglobalized measures, we were talking about a 30% gap. Between GDP and GNI star. Now we're kind of looking at it, GNI star being nearly half of GDP. We've growth on both sides of the economy, but I guess the M&E growth is a lot stronger, driving GDP and opening up that gap. So we have to just be conscious of that when we're using these other measures to assess educational spending, health spending, pensions, contributions, and items like that. If I look at them, I just produce them as a share of GDP as well, just to pull a number out of it. People might ask, what is the number? Well, GNP is 71% of GDP in 22. GNI star is 52% of GNP, and NNI is 46%. So we have to be conscious of the different levels of these indicators, but also across time that the gap is opening up as well. So it's even more important to switch from GDP to these indicators if it affects your assessment of what you're looking at. But just to put GDP back in the usual cross-country context, where other countries we don't have GNI star or NNI star necessarily yet for all these other countries, it puts us as usual on the far right with that 9.4% growth rate. Looking across the sectors, the NACE or industry sectors of the economy, we see that there's still large growth in industry of 18.7%. What I explained about the revisions to the base period means that's a little less. So we last came to you with industry at 23%, it's now down to 18.7%, again because of base effects. What you'll also see is construction. That might surprise you. We're saying construction growth is 4.2% for the year, and last time we said it was 14.4%, but that's largely again because of a revision upwards to construction in 21. So it's bringing up the base year more than the current year 22. On the other side of things, distribution, transport, hotels and restaurants at 16.9%. That's up from what we'd previously published at 11.6%. So some changes because of the revisions. It's important to kind of keep those in context when we're looking at the overall growth rates. But I guess the picture's still there, that it's still M&E sectors that are driving GDP rather than the domestic or other sectors of the economy. When we look at GVA broken down by these M&E dominated sectors. So I'll explain this a few times during the presentation, but the M&E dominated analysis is labeled sectors. So we pick a sector and say more than 85% of the turnover in that sector is M&Es. So that falls into this category we call M&E dominated. So the full M&E effect is obviously more than that, but it gives us a pretty good indicator on an annual and quarterly basis for what's going on. But again, the context for that is that we had that inflection point, I guess, in 21, where the M&E dominated sectors are now bigger than the rest of the economy. And that's grown again in 22, so that's now at 53% of the economy coming from these M&E dominated sectors. Some of the new results that we have, so these three methods of GDP by producers, incomes and expenditures, allow us to produce a lot more detail. So we have 38 levels of detail for the industry sectors now, showing you the difference between how turnover is broken down, equally split mainly between intermediate consumption and value added, but it varies across different sectors where the costs are a higher proportion of turnover, I guess, for sectors. So there's lots of detail in the publication on that if you want to look at how those cost to revenue ratios kind of work out across sectors. On the income side, we can look at the labour share of GDP. Again, a couple of years ago, we were talking about that at around a third. Now it's just over a quarter of GDP. That's the blue part of the pie there. The story is the pie is getting bigger. While the labour income or the COE data is growing, the labour share of GDP as a proportion is falling now to just over a quarter. That income data also lets us break down the different categories, things that add up to the income method: wages, profits, depreciation, taxes and subsidies, and how it brings us up to value added. And lets us look at the M&E dominated and the other contributions to it. So we can see that what we perhaps know is that the wages data has a lesser effect of M&Es on it, but while the profits and the depreciation data is largely dominated by M&Es. We just grab the figure off that. So 67% of the profits data is M&E dominated and 61% of the depreciation is M&E dominated. So again, there's detailed tables on that in today's publication. On the expenditure method, this is the one we regularly, I guess, look at, looking at the components of GDP and how we can strip away the M&E elements and come up with our measure modified final domestic demand. I guess the interesting thing there is looking at the growth of the modified investment. So if we build up modified domestic demand with the consumption we all spend on goods and services, government consumption, and then add on the investment that's free of IP and aircraft, we can see that's grown considerably in 22. We've looked at it across the quarters, but there's a summary measure of it, I guess, up from 42.2 to 48, so from 42 to nearly 50 billion on modified investment, and that's the plant and machinery that M&Es are spending here, as well as the back to office stuff that we saw earlier in 22 by domestic firms, and then data centres as well, I guess. So that's the big increase in that and how it's affecting modified domestic demand. We can weigh that up into the growth rate and look at the 9.4% growth rate and say which bits are coming from domestic demand, from foreign demand, and it's a lot more balanced, I guess, in 22 than it was in 21. Looking at the components then of the expenditure method: consumption, slightly different measure in Europe, individual and charities or NPISH, consumption expenditure, and again that puts us over on the far right with Malta just ahead of us. In today's publication, we also have these really detailed categories on consumption, about 30 details. So normally I can give you a verbal explanation each quarter what's going on with consumption. In the annual publication, we can see what's driving it. Hotels and restaurants there in 22 are up 26.8%. The recreation and culture is up 26%. Another big one, I guess, to look at there is the furniture, equipment, maintenance. That's up 16%. So these are all kind of the driving factors behind consumption that we don't normally have on a quarterly basis and are available today. On the bottom, you see the bigger category: alcohol, beverages, tobacco, and narcotics, down 5%, but 5.1%. And that was the headline I pulled out for the infographic. The alcohol component of that was what was driving the alcohol consumed at home, which is down in 22 over 21. So there's lots there in the publication if you want to go digging around and having a look. We also produced a new note today. It'll be separate on the items released from the two publications on national accounts on actual individual consumption. There's lots of charts and tables in this. This is just one we pulled out to explain what is this thing, actual individual consumption. We've added the variables into our publications, AIC, or actual individual consumption. It's the regular PCE consumption that we normally talk about, and it adds in the individual spending on individuals by government. So it's kind of, it balances out different taxation effects across different countries. So if one country taxes and spends more than another, it balances that out and looks at it across countries. It's also purchasing power adjusted across countries. So it takes into account the Eurostat PPP measure, and we apply that to today's data on consumption to update the charts and tables and analysis that Eurostat had previously produced. Lots of work still to do on this to understand it, to look at the purchasing power and how it's applied. But it just gives you an example of before purchasing power adjustment, we're about fourth in that list. And when you add in the different price effects in Ireland compared to other countries, it pushes us way down in this example below the EU average. But there's lots to look at in that publication if you want to see an alternative measure of consumption across Europe. On investment, again, we normally don't tell you too much about investment on a quarterly basis, but with the annual data, we've lots of detail there. And importantly, we've got the detail on machinery and equipment. I mentioned this one was, we looked at microdata now on it, and we see that the samples data for medium and large firms had a bigger weight in the high frequency data. Now with the annual data, we've got a full picture on that, and we think that the weights or the contribution of smaller firms is a little bit lower than we'd previously thought. So we've taken about 2 billion off machinery and equipment. I think it's in 21 and 22. But the growth rate's still there. It's still very strong growth, considerable growth. Machinery and equipment from 21 into 22. Some of these categories are a little smaller. This is just the growth rate on them. Again, you can see that in the publication. But dwellings, the third one, there is up 22.5%, while roads are down 9%, and other building and construction is down 7.5%. So, a lot more detailed analysis today on what we could talk about from the data. So just to finish up on the annual, so we have a new GDP growth rate of 9.4%, GNP 3.9. Again, that's with large, very large M&E outflows of nearly 140 billion, up from 110. An extra 30 billion in profits flowing out in 1 year, giving us these lower net rates of GNP, GNI, and GNI star, all affected by those large profit outflows. On the industry side, we have some revisions downwards of what we previously published for industry, in particular construction, but upwards then on distribution, transport, hotels and restaurants. Now at a figure of nearly 17%. But the picture overall is still that the M&E dominated sectors are still what's driving the GDP data. On the expenditure side, we've consumption up 9.4%. And modified domestic demand at a similar kind of measure at 9.5%. And we are finding that is working quite well. PCE, or consumption, and MDD are working, or are very high correlated now across the quarters and in the annual data. Before I look at the quarterly, I just want to make a kind of a brief analysis, I guess, on the price effects. I try to mention this every quarter to everybody, that when you're looking at tax receipts or spending or investment, a lot of what the data we're looking at is in current prices or in money terms. And we have to take account of price increases and all these things before we look at volume measures or real rates of growth. So here's an example for the GDP deflator once a year. It's a good time, I think, to look at that and say that we're looking at current prices or money terms. GDP is up 16.6%. We've presented it to you today in volume terms of 9.4, and that gives us this implied deflator of 6.6% as a general cost indicator across the economy. Consumption is a little bit easier to look at, it's a little easier to relate to what we spend on goods and services. So we're saying we're spending 16.5% more on goods and services in 22, but we're only getting 9.4% in volume for that. So that's showing you the price effect of 6.5%, again, which is close to what we look at in terms of the consumer price index. Looking at that across time for consumption, it shows you that gap, how it's opening up. That each period we go on, we have to spend more in order to get to keep the level even the same, we have to spend more because of price effects. So it's just worth keeping that in mind every time you look at data, particularly in 21 and 22 and going into 23. We haven't had to do that for a long time in the years prior to that, I guess. Very briefly then on the Q1, the revised Q1, what's happened there? Well, the fall in industry is not as much as we had before. So previously we had an industry value here of minus 18%, it's minus 13 now, and that largely explains the GDP growth rate of minus 2.8% instead of the nearly over 4% that we had 30 days ago. Another notable one is construction, up 4.3. We had it at 12. It's up 4.3% now. On the expenditure method, along the bottom of the infographic, consumption's weaker. PCE was 1.7. Now it's 0.1%, and similarly MDD is down to 0.1% too, largely related to that PCE revision. The question many of you asked me about, well, the 2 quarters again, that remains the same. You can't see data here for Q4 22 because they're both 0, or I call them 0, but if you really push me on this, GDP is plus 0 and MDD is minus 0, if you really want to push this one. But the picture remains the same there if you want to interpret it that way for the 2 quarters of GDP. And MDD is still positive, I guess, at 0.1%. Let me explain it a little bit more. We've come to you 3 times in the last 80 days or so with a version of Q1 23. And what was that for? Well, I guess the first time we come out, we have a new measure this year in 2023 about giving you a preliminary look at GDP using just the output method. And that gave us a minus 2.7 result. 30 days later, we have the output and the expenditure method, so the consumption, investment, government spending, and net exports. That gave us a measure there. Now today, we have an entirely different measure. So inside the CSO, we don't compare these two, but I guess outside you look at it's still GDP and it's the result for Q1. But why is it different? You have to take all those revisions I just explained to you for 21 and 22 into account. So we have a new level for GDP for 21 and 22. The base year then moves from 2020 to 2021 prices, so our indices for deflation move forward a year. And then we also carry out our annual review of seasonal adjustment. So we do that once a year, and then we hold the factors fixed. And the review of seasonal adjustment, for example, give us new adjustment factors for consumption. So that's what is the large driver in the downward effect on consumption, down from 1.7 to 0.1%, and the effect on MDD. That's all down to the new sets of seasonal factors picked up in the models there. So that's why we're back with the third version of the data. So normally we'll do this twice a quarter, but then once a year we have this extra version where we rebase everything. That's the result then when you put that minus 2.8% in the European context, still out there on the far left. So in the final slide for me, just to summarise that quarterly result, industry down, construction down from what we previously come out with, but we're still seeing this large M&E effect that's giving you the minus 2.8% on GDP. A large change to consumption and to MDD, both were above 1.7 down to 0.1%. For PCE, so it's less of a fall in GDP, but there's some seasonal adjustment effects on the expenditure side as well. So that's kind of the update for Q1 23. So at this stage, I'll pass over to John Sheridan to take you through the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts and our revised data for the last couple of years. So we have data revisions for the 13 quarters from Q1 20 to Q1 23, and we also have updated data series for our domiciled PLCs, for CA Star, and our US current account. So looking first at what's changed in Q1 23 since we last published, you can see the differences are quite small. So we've reduced merchandise surplus by 106 million, our services balance has increased by 657 million, and our net income outflows have increased by 816 million. And these all combine to give us a current account balance of 13.6 billion, which is down 264 million on when we published last. Looking at these revisions over the 13 quarters, we can see there's very low levels of revision to our net merchandise. with 2020 overall changing by 316 million, an increase of 316 million, 21 increasing by 1.2 billion, and 22 decreasing by 2.1 billion. We see a slightly different picture when we look at our services. So 2020 changed, decreasing by just 196 million overall, and 21 increased by 4.9 billion across the year. But in 22, we do have an increase of 16.5 billion in the services balance, driven by revisions to levels of IP imports, particularly in Q3 22. Looking at our net income balance, we can see reasonable revisions across the 3 years, but nothing large. In 2020, they increased by 889 million across the year. 21, the outflows increased by 7.2 billion across the year. And in 22, the outflows increased by 4.1 billion across the year. And these all combine to give us our revisions to the current account balance, with the 2020 current account balance changing overall by 1 billion, increasing. 21 decreasing by 1.1 billion, and 22 increasing by 10.4 billion across the year. So now to look at our updated redomiciled PLCs, the net income inflows for the redomiciled PLCs act to reduce our net income outflows. And we can see that the net income inflows for redomiciled PLCs in 22 was 5 billion euros. And following the increase of 21, we're back to levels similar to 2019 and 2020. Looking at their impact on direct investments, we can see in 22 that redomiciled PLCs made up 506 billion of our direct investment abroad, which is 45% of our total direct investment abroad. We've also updated our modified current account balance, or CA star, including revisions for 2020 and 2021. So we now have our current account star for 2020 of 14.5 billion. In 21, it's 23.4 billion. And in 22, it's 19.5 billion, comparing with our overall current account balance for 22 of 54.6 billion. To examine these revisions a bit more closely, we can see that our 2020 figure of 14.5 billion is up 1.4 billion on our last published figures. And our 2021 figure of 23.4 billion is down 2.6 billion on our last published figures. And looking at it as a percentage of GDP, we can see that CA star is 3.9% of GDP in 2020, 5.4% of GDP in 21, and 3.9% of GDP in 22, which compares with the overall current account balance, which is 10.8% of GDP in 22. And just to look at the adjustments over time, we can see that green bar is the IP imports, and so the volatility in the adjustments is often driven by large levels of IP imports in particular years. With low levels of IP imports in 21 and 22, we see that the adjustment is fairly stable across the 2 years, and that the change in CA star from 21 to 22 tracks the overall change in the current account balance. So we've also begun taking a closer look at special purpose entities in Ireland. And SPEs, or special purpose entities, are legal entities set up with a specific purpose, such as pass-through of financial investments or holding overseas assets and liabilities. And they have little or no employment, little or no physical presence or physical production. They're directly or indirectly controlled by non-residents and transact almost entirely with non-residents. And these are of increasing international interest, in particular their impact on FDI. When we look at SPEs overall, we can see fairly high levels of assets and liabilities, with in Q1 2023 assets of 664 billion and liabilities of 660 billion. But we can see that these are almost balanced, having a negligible effect on our net IAP. Looking at the types of assets and liabilities they hold, we can see that the assets and liabilities are predominantly made up of debt as opposed to equity. With equity in Q1 23, assets of 90 billion and liabilities of 54 billion, while debt was 574 billion of assets and 606 billion of liabilities. So how much of this is FDI? So of this 660 billion of liabilities, 54 billion is made up of inward FDI. And we can see that that makes up just 4.3% of our total inward FDI. So we can see that it's a relatively small impact on our overall FDI. And the rest of the SPE assets and liabilities are a mix of portfolio and other investments. Another thing that people think about when they think of SPEs is pass-through FDI. So pass-through is where foreign M&Es invest in Irish affiliates, which then invest in another economy, so that the investment essentially passes through Ireland. When we look at figures for Ireland, we can see that of the 1.3 trillion total inward investment in Q1 23, 360 billion of this passed through Ireland, making up 28.6% of the total. But when we look at how much of this is contributed by SPEs, we see that it's a much smaller number, with SPEs contributing 54 billion of this 360 billion, making up about 15%. So the majority of pass-through for Ireland is actually through other types of entities or through the M&E structures. So now to look at the US current account. We can see the current account deficit increasing strongly from 20.7 billion in 2020 to 110.2 billion in 21 to 158.2 billion in 22. We can see that the merchandise surplus with the US is staying relatively stable, but that this is being driven by increases in the service deficit, which has gone from 70.3 in 20 to 101.9 billion to 130.3 billion in 22, and the income outflows, which have gone from 1.7 billion in 20 to 49.6 billion in 21 and 81.4 billion in 22. So just to look at these a bit more closely, we can see here the service imports across these 4 years. And when you look at from 2019 to 2020, the total change in service imports is relatively low. But we can see a dramatic drop off in service imports from offshore centres, and then a corresponding dramatic increase in imports directly from the US. And looking at the direct investment income outflows and how they've changed, we see here the blue line is the income that flows directly to the US, where the US is the next counterpart. Whereas when we look at the UIE picture, which is the green line, this is income flowing to affiliates of US companies, and so it would ultimately accrue to the US. The change from 20 to 21 is partly due to an overall increase in outflows, but it's partly due to income now going directly to the US rather than through affiliates in other countries. But when we look at the change from 21 to 22, it is all driven by the overall increase, and this is reflected in the overall increase in net total income outflow. So now that we have our current account balance for the US, UK and EU and others, we can look at a geographic breakdown of these current account inflows and outflows. So this graph shows money flows from the left to the right. So on the left, we can see money flowing into Ireland from the UK, US, EMU countries, which are countries in the Eurozone, and other countries or the rest of the world. And this income is generated by the proceeds from exports of goods and services and income inflows. While on the right, we can see the money flowing out of Ireland to the UK, US, EMU countries and other countries. And this is the funding of imports of goods and services and income outflows, like the outflows of multinational profits. The size of each piece gives the relative contribution, and the difference between the sides gives the current account balance. So you can see that small gap at the bottom is our current account balance, and it's made up of these really large inflows and outflows. We can see the inflows are fairly well geographically spread, while a big proportion of the outflows are going directly to the US. Looking at this just for merchandise, on the left, again, we can see the diverse spread of our exports, and on the right, we can just see the much lower level of imports, with the difference between these sides reflecting the large merchandise surplus. And looking at services, this looks like a much more balanced inflow and outflow, but you have to note that the left reflects exports of services, for example, computer services, and we can see that this is quite well geographically spread. Whereas the right reflects imports of services, and many of these imports are supporting the production of not only services but also goods, for example, royalty imports. And we can see the large level of imports from the US. And then looking at our income flows, we can see the low levels of income inflows on the left and the much larger level of income outflows on the right. and these are largely the outflows of profits generated by multinationals. And again, we can see the large level of outflows directly to the US, as we saw in the US current account. So to summarise the annual revisions, we can see our continued growth in our merchandise surplus, moving from 142.5 billion in 2020 to 168.5 billion in 21 and 202.3 billion in 22. And also a continuing increase in our net income outflows, going from 95.1 billion in 20 to 114.4 billion in 21 and 147.5 billion in 22. While the services balance volatility is largely driven by differences in levels of IP imports into different years. And these all combine to give us our current account balance in 20 of minus 24.5 billion, which compares to CA star, which is 14.5 billion. 21 is 59.5 billion, which compares to a CA star figure of 23.4. And the current account balance in 22 is 54.6 billion, which compares to a CA star figure of 19.5. And looking at our Q1 overall, we can see our goods surplus of 56 billion, our services deficit of 0.8 billion, and our net income outflows of 41.6 billion, which all combine to give us our current account balance of 13.6 billion or 10.7% of GDP. And we have our net international investment position of minus 558 billion, and our foreign direct investment in Ireland stands at 1.3 trillion at the end of Q1 23. So now I'd like to pass back to Jennifer to wrap up.
Many thanks to Chris and John for taking us through the results. I'll just take a minute today to talk about upcoming developments or future developments across the national and international accounts. So just to flag for yourselves that 2024, so when we're here this time next year, it will be a benchmark revision year under the harmonised Eurovision revision policy. But as we talk to you across the year at the briefings, we'll update you on how that's progressing, and we will have obviously support information around the revisions next year. The objective is to have a common year across Europe where you have a consistent length of revisions, if I can put it that way, back along the time series to the key aggregates, the key macroeconomic aggregates. What's also reaching an end of the discussion phase are the work to update the standards for national accounts and balance of payments. So the final sign off on those new standards will be 2025. So that's the SNA, System of National Accounts. So it'll be the SNA 2025. And the new version of the Balance of Payments Manual will be BPM 7. For the national accounts and for the balance of payments, they are implemented again in a harmonised way across the European member states. And the way that's achieved is through legislation. So there will be EU legislation for the new standards finalised in 2028, and then we'll be implementing the new standards in the member states in 2029, again in a harmonised way. But again, we've been doing a lot of work through the discussions and ourselves on the implications for the new standards. So we'll be talking to you every year as the progress is happening on the implementation of those new standards. But I wanted to highlight a couple of things from the discussions. There is a continued focus on the globalisation measurement challenge as part of the discussions of the SNA and the balance of payments standards. There is a focus, an increased focus on the net indicators. Chris has talked through the net national income or NNI indicator today and shown that walk from GDP to GNI star, which is our version of a deglobalised indicator, but also showed that walk from GDP to NNI. And what we're seeing for Ireland is we have our GNI star, which was designed as a level, an indicator of our deglobalised level of the Irish economy, just over 50% of GDP in 2022, and NNI just under 50% of GDP in 2022. So, as Chris has highlighted, that gives you an indication of the extent of the globalisation impact on GDP, but also these alternatives that are there. And as more statistical offices progress on compilation of NNI, or the net indicators, we will have, I suppose, a very deglobalised indicator of economic activity that measures the whole of the economy that we'll be able to compare across countries. There's also been a lot of discussion on the boundaries of the national accounts as well. and a lot of progress on kind of incorporating environmental concerns and issues within the national accounts. So I just highlighted one here. So there will be work to include evaluation and a depletion of natural resources within the national accounts framework as well. So to mirror the growth, well, what's the impact on our natural resources, the depletion of natural resources that's behind the growth. So a lot of work, but a lot of very interesting discussions and technical papers. For anyone who's interested, we can send on links around that background. But again, we'll be informing you as those blocks of work are progressing. Okay. So just as people are pulling their questions together, I just wanted to highlight the few key figures for 2022. I'll use the infographic there as well. So we have our whole of economy indicators, so those indicators that take in all of the activity, both multinational and domestic. In 2022, we have GDP up 9.4%, GMP up 3.9%, and then the net national income indicator up 4.2%, our GNI star up 6.7% in 2022. So that gives you that view of that whole of economy indicator, and Chris and John have explained, I suppose, what's happening across those different views of the economy. Focusing in on the domestically focused indicators, so modified domestic demand, which is personal government spending and also investment spending, but then we take out intellectual property and aircraft leasing impact. That's up 9.5% in 2022. Drilling down even further again, personal spending, so what we spend on goods and services, up 9% in the year in 2022. And then just another interesting I suppose domestically focused indicator to pull out there from all the information you've had today, the wage bill, that's up 8% as well. So I mean, if we take that basket of those three domestically focused indicators, we're seeing 9.5% increase, 9% increase, and then the wages up 8% in 2022 for the domestic, the more domestically focused sectors, indicators. Apologies. Okay. So many thanks again to Chris and John for taking us through the results, and we have an opportunity for some questions now. So as I say, if people wanted to use the chat function or raise hands, but as I say, we also have colleagues in the room as well who may have questions. Okay. I go to the room first, if that's easier. Yeah.
I have 5 arcane questions, okay, so we'll take other people first.
No, we'll start, John. So John, just for people online, so we have some questions from John Fitzgerald in the room, so that's fine. And let me know if somebody can put into the chat. If you can't hear, I can repeat. But anyway,
firstly,
yeah.
I welcome that you're going to try and produce net national income quarterly. Will it be at constant prices? That would be extremely useful. Slide 28. Net national income and GNI star. There's the NI at constant prices is up 4.2 compared to 6.7 for GNI star. Is the difference redomiciled PLCs? And if so, it would be useful in your tables if you could show the constant price redomiciled PLC. I'd like you to produce NI star, but I'm sure you'd have reluctant to do that, but I can produce my own if you show the constant price figure. Next is the slide 5. There seems to be a huge revision to the 2015 figure, which actually makes it look more plausible. That previously in the last round of the national accounts, GNI star was down 2% in 2015, which seemed bizarre. Now it looks from your graph as if it's up 4%. There doesn't appear to be any change in the GDP growth rate, and I just wonder what the explanation for that is. On slide 26, that's the AIC per head adjusted for PPS. Seamus Coffey has raised major issues about the PPS deflator. And I was at a Bureau of Economic Analysis seminar, US Bureau of Economic, where they were discussing how you deal with housing prices. That the PPS data look as if they take account of the fact that if you want to buy a house in Ireland, it's far more expensive than in Greece. But it is if every house was put on sale simultaneously, the house prices would be dramatically lower. And it is whether the price deflator you use in imputing rent in consumption is consistent with the PPS deflator, because what the table shows is the Irish standard of living is below the EU 27 average in terms of consumption, and it just doesn't look plausible. And Seamus has raised this issue, and I just wonder, is the PPS deflator for housing consistent with your deflator in the imputed rent? Because if it's not, that may explain that rather counterintuitive result. The last 2 points were just, I know the CSO is at the forefront in revising the methodology of international accounts worldwide. So I presume you will have a seminar at some stage to explain what's going on there. And final question, this one is simple. When will you have, I think you normally publish the annual national accounts tables in 2 tranches, one today, and it's when the final tranche will be published. Will it be October, August, will it be September?
Many thanks, John. I'll start with
A couple of those and head you back to seminar.
Yeah.
So NNI, I guess we've tested it it's really our 3rd year of producing NNI annually, and it really does work. Like, it really is picking up all the things we expect it to, and then with the momentum from the international set of standards saying, yeah, we should start looking at net measures, because nobody likes depreciation, putting money values on depreciation and what it means. So net measures are picking up a lot of momentum. So the last steps, if we can do depreciation quarterly now, we did that in an experimental release a couple of months ago. So now we're looking at the deflators on assets to see if we can get onto a constant price version of that. So we're close enough, I think, with that. We haven't produced that yet, so that's kind of a work agenda item for us, but I think it's one that we want to progress. On slide 28, is it the PLCs affecting the growth rate? Yeah, it is. So this ties in with your question about NNI and adjusting it further for PLCs. The PLC data was nice and stable, I think, around 5 billion for a number of years, and then suddenly it doubled, I think, in 21, and that's what's caused us a lot of difficulty in interpreting the modified measures in 21 and 22. So yeah, I think that's the appropriate thing to do, for us to produce NNI and to produce the PLC data alongside it, to allow people, if needed, hopefully it won't be needed going forward, but if it is needed, it's there. But we still keep the measure that other countries can come along and say, yeah, we have that too. There is, just for the set of net measures, like, there's large profit outflows in 22. So for us, we were kind of thinking, would there be more in 21? And here we see a lot of profit outflows in 22. We always have those kind of timing issues. So a firm's accounts can flow across calendar years. So GNP, GNI and NNI, they're all affected by those profit outflows too. So it's not just PLCs, but yeah, they definitely have an effect on the interpretation of NNI. I'll have to check the GNI star growth rate in 2015. I do always check the GDP growth rate each year to make sure when we do revisions that how we change that. But I guess it's the deflators. Something must have happened for those in 2015. So I might have to come back to you individually on that if you don't mind. I take all your points on AIC. I think I guess I'm just really interested in a cross-country measure that takes into account difference in taxation across countries and how it affects welfare or consumption. The point's well made about housing. I think we'd all like to see it in the ranking. Ireland's a bit higher on that, but then again, we have a bias on this. So I'm not sure where to, because we're Irish, I think maybe we're above the EU average. I think we all think that, but I'd love to see some data on that. So yeah, it'd be great to look into how housing's measured in the PPPs, make sure it's consistent with imputed rents, the cost of housing, and if there is a revision there, and brought it back up towards or above the EU average. But we can, I think the message is still there. It's quite clear in it though, that because prices in Ireland tend to be higher than a lot of other EU countries, it just pull us down. So even though we consume more, and because of prices, we have to measure that up and say we are further down the ranking because of that. And we tried to explore that a couple of different ways in the note, using a ranking instead of the absolute amounts. Yeah, we have a second tranche. Usually there's very little. I think this year, the one thing that's in the second tranche of data for the is saving. So next Friday, our sector accounts colleagues will produce household saving. That's the thing that I guess we're waiting for. That's the informative one, I think, is the household saving. And then we'll reproduce a set of tables that match that. But I think you'll get your information you need next Friday, and then we'll produce the set of tables and put them in pretty soon after that. I'll hand the seminar over to you.
No, I mean, absolutely, and probably a series of seminars, so not that you've asked. But I think what we would plan on doing would be a whole programme of communications and supporting documentation around the implementation of the new standards, and in advance describing them as simply as we can, as clearly as we can, and trying to anticipate where the impact will be on the Irish results as well. Obviously building that up, and we might take it together with other work that's progressing. And Chris, and you've mentioned on the PPPs as well. And there's, we're always looking at work there and what we can progress and what we can develop and what we can use in a cross-cutting way. So there's opportunity there for seminars on the new standards as well, but also maybe to broaden it as well on the broader suite of economic statistics and how we're making developments there to help users. And then exactly when at the time of implementation, we'll have our regular briefings as well, but we'll follow that with I guess a more detailed session taking through particularly the changes to the standards that have a significant impact on the Irish aggregates. And at a European level, they're already identifying task forces, and we're putting our hands up on some of them to see, well, particularly for the, what we suspect will drive the significant revisions to ourselves, to be involved in that, and then we can communicate that to yourselves as well. The question will be around the retrospection. And the length of retrospection we can take back. And obviously we're very conscious of the importance of building consistent long time series. That's a part of our mandate, and it's something that we'll be focusing on, and we'll do what we can obviously with that. And I think we'll push ourselves to try and see how far back we can go with the new standards. And it may be in phases, but that's something that's very much part of our project plan as well. Okay. There's a question on the chat, if that's okay, just to take it for John actually from Mushy Tarrant. Thanks for the presentation. Regarding the downward revisions to IP imports, what explains this? Is it related to a revaluation of IP or related to a move of some IP out of the country, John? So that revision there, I think Qtrly 2022.
So it was a revaluation of the existing imports. I think just based on new information, the value of what was imported was lower than what had originally been reported to us. So it's not that there's any new IP in that year that counterbalances what was there or anything like that. Okay. Sorry, there was a hand, but it's gone again now, just to give somebody an opportunity in case they wanted to raise it again. Okay. If there's nothing else from the room or nothing, no, I better check the chat. No, okay, that's it. Just to repeat again, as I said, that the presentation from today will be available on our CSO YouTube channel. The contact details are available on the statistical publications and on our press release as well. So if there's anything subsequently that you wanted to make contact with us on any aspect of the results from today, please use those contact details. Okay, many thanks.